This was the silver lining I was speaking about. And that is very relevant. The silver lining or the good news or bad news, all of it is for listed MLDs. But let me explain again. What did the finance minister, honorable finance minister, say is, don't take the trouble of selling it before maturity to get capital gain. Earlier, every MLD owner, the listed MLD owner, had to sell it before maturity to accrue himself or herself a capital gain. The minister said, why are you doing this transaction for a formality? As long as you're okay to keep it under the capital gain head of short-term gains, I'm okay if you mature it also and don't sell it before. You will still not get interest income, but you will still get short-term capital gain. This might look like a very simple English or technical statement, but capital gain head is a very, very flexible head because of Section 73. It's a very flexible head. Equity can throw up losses and it can set it off, right? In so many other assets, indexed losses can set off capital gains on the long-term side. So once she said that I'm moving it not from interest income, but you will not have interest income, but you will have capital gain, seems like, how do I care? Everybody looks at only the optical rate, 30%, 30%. Both are 30%. So how does it matter? She counts it as interest income or short-term capital. If it moves from this head, interest income comes under a head called income from other sources. If that word, instead of interest income, she says, I'll count it as capital gain, rates optically might be identical, 30-30, if for a maximum slab. But this is 30-year with so many Section 73 and subsections provisions could mean as little as 10-12% as well. So the silver lining in the dark cloud for listed MLDs was that even if you surrender it on maturity to the issuer, you will be counting it as capital gain, which has not been given to any other debenture as well. So this generosity shown itself means that the ministry hates the fact that you're taking a 10% credit, but does not want to take you to the other extreme and punishing you like cryptocurrency. We completely agree that when tax laws change, only one product which locks in the tax laws is insurance. Insurance as an instrument, only one financial instrument which locks in the taxation at the point of entry. So can the tax laws change in the next 2 years, 3 years, 5 years, favorably or unfavorably? The answer is yes. Now coming to, if unlisted MLDs were also being included, to my mind, there is no reason. So why? Because they are already at a disadvantage than debt mutual funds. If there was an advantage vis-a-vis debt mutual funds, then there was a possibility that it will get plugged because there's an advantage. Advantages gets plugged. And that's what has happened. Now, unlisted MLDs, if they came into this circular, I still personally think it will not have any impact given the 5-6 provisions which you can currently use. So now, for example, as we have recommended, and we have this huge principle that we recommend to clients what we buy ourselves. Let me tell you my own example. In the last few years, if MLD taxation uses all the provisions available, I have not personally ended up paying more than 15-16% tax on the MLD maturity.